It's always helpful to have an outside perspective, and not be wed to like previous conventions that may or may not be accurate or correct.
Hello, ladies and gentlemen. Welcome back to Commercial Real Estate Secrets from your host, Austin Hare. And our guest is Elliot Zibel. He is CEO and co-founder of Select Dental Management. Now, they started in 2018, and they already have 32 locations under their belt, which is rapid growth in a short amount of time. And the annual revenue per location averages at $2.5 million. So they're also high-producing locations as well. So, Elliot, thanks for your time today. It's a pleasure to have you on the show, my man. How's it going?
Good. Thanks for having me.
Yeah, so, we were connecting earlier, and I love your story because it's a little bit different than the average DSO or the average dentalpreneur, and being that you started out in Wall Street for a little bit. So how did you end up on Wall Street? Like, what kind of led you down that path to start over there?
Yeah, it's a good question. I ask myself that question every day. How did I get here? I started out, I grew up in West Hartford, Connecticut with my now partner, Dr. Jonathan Mason. So my partner and I have known each other since we were 5 years old. And we both went to college in upstate New York, stayed in close contact. After graduating from college, I went to work on Wall Street for 15 years, and he went to go be a dentist. His father was a dentist in a nearby town from where we grew up. And Dr. Mason went and worked for his father for 6 years, ended up deciding he wanted to go and live a different pace of life, and he bought a 5-op fee-for-service practice up in Manchester, Vermont, doing about $800,000 a year in collections. This is in 2015. About 2 years later, him and I were together. We were just talking, hanging out with our families, and I asked him how his practice was going. He told me he had grown the practice from $800,000 to about $1.7 million in collections in a couple years. And that caught my attention, and started asking him a lot of questions about how he did that, and really it was all about providing great care and experience for patients and being transparent and honest about what their issues were and communicating the importance of taking care of their oral health. And after I sort of learned about what he did, I thought what he had done would be replicable and scalable. And at the same time, while he was enjoying the growth in his practice, it was hard for him to manage the non-clinical aspects of dentistry. Like, he didn't really learn in dental school how to manage the business, nor did he really honestly want to manage the business. He wanted to do dentistry and have a good work-life balance and spend time with his family. And so actually that night that we were talking about this, and I remember exactly where we were, like I sort of came up in my head. I said to my wife, like, I think we have our next idea that we can focus on. And my background prior to this was I invested in primarily public companies, $1 billion plus in market cap, across different types of
$1 billion portfolio? Or you said you had companies that had $1 billion in market cap?
Companies that were $1 billion plus in market cap. There were different points in my career where, our average investment would be, 50 million up to 300 million per company. So I did have a lot of experience in investing in a substantial amount of capital.
Let's talk about that for a little bit, because that's no easy feat either. Like, a lot of guys, they see movies like Wolf on Wall Street or whatever that just glamorize this whole Wall Street experience. So they want to be the brokers, and they see all the money that you can make, but it's not easy. I mean, I would argue that it's one of the most competitive, cutthroat jobs in the entire universe, but there is a lot of money to be made. So, I mean, you said you guys grew up in upstate New York. Was that
in Connecticut, and then went to college in upstate New York? Yeah.
Okay. So in college, did you know that you wanted to be a broker, work on Wall Street? I mean, what was that?
Yeah, so I did not. I thought I wanted to be a lawyer, so I was like poli-sci major. Realized I wasn't really super intrigued by that. And when I went to school in '98, it was sort of the height of the internet, bubble, and so I started investing in stocks. I think I lost the money I put in, and I literally got in at the top, lost all my money very quickly. But really was intrigued by the market, and had to hustle to get from Union College, where I went to undergrad, to Wall Street, because most of the bigger banks and asset management firms are only recruiting at Ivy League schools primarily. And so I convinced an alumni from my school. I kind of cold called these guys and emailed them and said, hey, looking for an internship. Got an internship my junior year in college. from Union alumni, did well there, and I got brought on full time after school there, and that was really a great foundational education. We had about a $2 billion portfolio of stocks, and I was an analyst, and I worked with the two key decision makers at the firm, and they really, I mean, they always say, like, having a good mentor, it's like, it's unbelievably important. And, you know, what I learned at Matrix Asset Advisors, where I started, was just the importance of hard work, you know, really being thorough and doing research and building relationships with people and having conviction in your ideas. And so it was, you know, really great.
I want to kind of talk about this a little bit because, you know, I like investing in the stock market, and I got a couple of people that I follow. Not that I'm smart enough to figure it out on my own, but you know, it just seems so overwhelmingly complicated. And like you said, you bought in at the height of the dot-com bubble. It seems like that's what happens with every everyday person who doesn't have access to inside, you know, information. Is like, you see things going up, you get FOMO, you buy in. At that stage, the institutional investors have locked in all their profits because they were in early. They sell, you lose your money, you get out. So, you know, I'm just curious, like, if we can just briefly kind of go through, like, what kind of indicators did you learn about to look at for, hey, these are good entry points, these are good times to get in stocks, these are undervalued, versus, like, I mean, how long do you hold them?
So I've always been a long-term investor, and I think what I traditionally will look for is, you know, it's all about what's your upside, what's your downside, and what's your probability or your conviction in that upside scenario, and that allows you to think, you know, about where you should kind of focus your capital and make big bets. And when there's a lot of upside and not a lot of downside, and you're convicted in the upside, like, push your chips in and make a bet. I think it's really important on Wall Street to have a variant view, right? You know, now, again, I haven't been working on Wall Street for several years, and things have changed, and now it's, I guess, not as important to have a variant view. But when I was there, you know, you wanted to buy things where, you know, you had a different view on earnings power or cash flow generation or business quality over the long term. So I wasn't investing in quarters, and, you know, that's just not the way that I understand how to invest. I was investing in high quality businesses that have secular growth tailwinds, are well positioned in their industries, and where I had a variant view on either the business quality or the earnings power over time. And if you get that right, it's a really good way to compound capital over time. We look to compound our capital, you know, 20+% a year, and that's something that, you know, over my career I've achieved in the public markets, and honestly substantially higher than that in the private markets, because the private markets are much more asymmetric.
And you have a little bit of control over it, right? Like, you get a little bit more control in the private market versus the public markets. It's completely outside of your control.
Yeah, there's just things, and part of the reason I left Wall Street, honestly, was it just became way too short-term oriented, and you know, that's just not the way I like to do a lot of work and do my research, and then make my bets, and you know, if you have, it's hard, you know, if you have a $100 million position down 20%, right? It's hard to have the wherewithal to kind of keep that conviction when you're getting a lot of pressure from outside forces and the market is telling you that you're wrong.
Real quick, what were the best and worst trades you've made?
Let's see, the best trade I ever made. There's a couple. I mean, probably Dollar General. Honestly, it went public from KKR. I think it was like, it's been probably a 10x return in a decade on, like, a very stable, great business with a great leadership team. Let's see, worst trade. A company called HomeServe, which is like provide home insurance products to households in the UK and now in the US, and there was like we identified this one risk that if, like, you know, if there was a regulatory issue, like, it'd be a big problem, and we did all this research, and we didn't think it was likely that would happen, and like 3 months after we bought the stock, like, the regulatory risk actually happened out of nowhere, and, you know, we woke up one day, stock was down 50%, like, you know, just opened up down 50. So that was not my favorite day.
So what gave you conviction to buy? You said it was Dollar General?
Dollar General, yeah, just research and looking at, I mean, investing, it's like, for me, it's like, you know, history tells a lot about the future. And so understanding, you know, how companies get from point A to point B, and their formula or algorithm for growth is critical. And the more, again, like, as you as that becomes easier to understand and more predictable, there's more value to the business. And I think the same thing happens in, everyone likes to talk about valuations in dental. Like there's a lot of disparity between valuations of group practices and single practices. And it's all related to ultimately risk, right? How diversified are those assets? And it's also related to conviction and growth. Like what are people's or investors' conviction that this platform can grow EBITDA or cash flow over time, right? And that conviction is driven by, do you have a platform? Do you have good doctor retention? Do you have culture? Do you have team member retention, right? Do you have integrated financial systems? Do you have an HR function? Like all of those things are leading to higher valuations if you have them, because then investors can sit there and say, hey, I have conviction that in 3 or 4 or 5 or 6 years, here's what your business is going to earn. And if you have conviction in that growth, you can pay a higher multiple day one. If you don't, you can't.
Yeah. Okay. So it's just doing, the work nobody wants to do. I'm guessing you were reading financial reports and quarterly earnings and that sort of thing, and creating your thesis around why you think it's going to go up. So yeah, that's good. And I love how it translates over, into everything, right? Every business venture that you do, every aspect of investing, like these are core tenets that you need to take with you. So was there, like, between Wall Street and investing, you said you did some investing in some private companies too. What was in between, when you finished Wall Street and you started doing DSOs?
Well, I started directly, and so basically, I started directly into dental. I left Wall Street to full-time run the dental platform. And basically what I found as I did the research on dental, at first I was like, oh, great idea. This is going to be interesting, and maybe I'm the first one to think about it. Come to realize, every private equity group in their brother has a dental platform. Yeah. And so I did a bunch of research on the industry, and I also was able to get in front of a lot of the CEOs of the larger groups, and was really able to get conviction in the drivers of dental consolidation at the time, which I think are only even more well known and understood now. And so as I looked at the landscape and looked at how fragmented the market was versus other components of medical and all the different pressures on doctors with student loan debt and sort of flat earnings for a long period of time, it seemed obvious to me that there's going to be a lot of need for buyers in the dental market over time, and so I decided to leave Wall Street and pursue this full time, because again, I had conviction in the risk reward of, hey, I know what I can buy these practices for. I know if we can improve them and optimize them, what those pro forma or adjusted valuation numbers would look like, and that was really, really attractive to me. And so that's really, I really just kind of went all in, honestly, and just sort of dug in. And I had honestly, it sounds like it being an investor is an advantage, and in some ways it is, but I always operated at a high level. I was dealing with the CEO, the CFO, the board of directors. I wasn't making the sausage, right? I was looking at these nice, clean financial reports. I didn't understand how they actually got from a transaction to a financial report. Mm-hmm. And even in other companies that were earlier stage that I invested in and was involved in or on the board of, again, it's much more high level. It's easy to kind of come in there and look at numbers and, make comments or suggestions. But, I learned the hard way of the challenges of, being an entrepreneur and growing a business from zero to something. And, if I were to do it again, I'd do a lot of things differently.
Yeah, sure. Yeah, of course. That's it. I mean, you just can't know everything, right? No matter what, you have to get your hands dirty. And so, when you said, and you're talking 2018, right? Was that your first attempt at dental? Was 2018, or did you do anything before that?
2018. So I left my job in Wall Street 2017. This conversation I said with Dr. Mason happened in July of 17. And by December, I had started the company, and by January, we acquired our first practice.
Wow, that's great. And so, I know we're hopping around a little bit, but I know you also did a little bit in real estate, right? So what's the timeline for that? When did you first start investing in real estate, and what kind of asset class was it?
Yeah, so in real estate, I mean, I was a generalist, so I invested in all different types of assets, for my professional career, and also personally, I was so leveraged to like the financial markets. That's where I was getting compensated and where most of my net worth was. So I always like to diversify in private investments in real estate, which were more income producing assets. So I've done probably the bulk of my real estate's been in more kind of multifamily residential, and also have done single family and self storage assets as well. And I have done some dental deals as well recently, both for our company and have evaluated some
deals that you did. So like multifamily, were you a limited partner? Were you help syndicating? I mean, what was your role there?
Yeah. So I was an LP. There's a great sponsor, guy who, in my view, it's like I'm a value investor, and so it was we bought. I mean, the first asset we bought, and it was like a multifamily. It was like 250 units in Charlotte. It's like a C asset with like 80% occupancy rates, and like rents were way below market. And we put a bunch of capital in to improve the asset, and we were able to increase occupancy to the high 90s, increase rental rates, and we basically effectively created it for like a low double-digit, mid-teens type of cap rate.
Wow.
And within a year of investment, we pulled out, we pulled out all of our capital, refinanced,
Wow.
The facility, and then sort of used that capital to go buy other assets in North Carolina.
That's what I love about real estate is the refinance aspect of using the bank's money. I know it can be scary for a lot of people, but when you have like we said, income producing, right? Like when the tenants are paying for the monthly obligations. And you can get so you have to put down your down payment to buy the asset, and then the bank is going to finance you a certain amount in commercial, right? We're talking 70%. So you're coming out of pocket like a lot more than residential. But if you have decent cash flow, then what you can do is you refinance that. You pull all your money out, or almost all your money out. You still have a little bit of cash flow, but you've got all your money back, right? So essentially, at that stage, like your ROI is almost infinite. You know what I mean? Because your money was only out for a certain period of time. Now you can go take that and recycle it, and do that over and over and over again. And it's a formula for infinite scalability, and that's what you guys have done at the multifamily level. So I was going to ask, what do you think your IRR is? But it's almost impossible. It's not impossible to calculate, but it's like you're doing it on phantom equity. So have you tried IRR, your ROI?
I mean, in a deal like that, it's kind of like to your point, it's really really high. Obviously, It's almost because because your IRR is driven by like the length, the duration your capital is outlaid, right? So if you're getting 100% of your capital back in whatever, I don't remember if it was a year or a little longer, and then you're still getting cash flow, and obviously that it's really attractive IRR. I mean, so I mean, I will say it's interesting. Like I do think like my partners that have done different real estate deals with. Like, yeah, it seems smart, but honestly, if we just held on to and like eventually we sold those assets, and if we just held on to them forever, like that's how real wealth is created like if I think about the wealthiest families that I know where I live, and there's some super wealthy families, almost all of them, come from real estate. And they've owned real estate for a long
time. When you say hold, are you talking about refinancing and holding, or you mean not refinancing at all?
No, refinancing and holding. Yeah, we also ended up selling the assets and so on. But yeah, it's and then you just let your to your point, your renters amortize your principal payments, and you at the end of some time period you own the asset free and clear, and you own more and more and more assets. It's an interesting way to be able to.
I mean, and there's a level of risk, obviously. Like if you got to have some buffer in there between the mortgages and the rent, because you're going to have things that come up. You're going to have vacancies. You're going to have expenditures and stuff like that. But if you've got, a little bit of margin in there after you refinance, for the most part, like it's a formula. And you got to have equity in the building too, right? I think where people get in trouble is they'll refinance to the amount where they've taken, the debt is equal to the value of the building. And in that case, if you have market correction, you're screwed. But if you got 20% equity, usually that's what the banks require. You can afford a 20% correction in the market where you can offload that asset if for some reason you're not generating your rent and still be safe, right? So I think that, it's easy to look at 2008 and think, that's how you lose your money, you get over leveraged, blah, blah, blah. But there are ways to do it smart while using leverage, but not getting over leveraged. It sounds like that's what you guys are doing. So, on that note too, like you said, you had a dental deal. Can you walk us through the some of the high level parts of the dental real estate deal that you did?
Yeah, I mean, it's interesting for dental. So if you look at the REITs, the healthcare REITs, public REITs, like they're their cost of capital, their dividend yield is like low single digits, like 3-4. I don't know exactly, but it's like 3-4%. And so, meaning like that's the yield that their investors are looking for, on those assets. And when you look at, like, depending on the dental market, dental is I would argue, a really nice asset, right? Recession resistant, secular growth over time. If you have a long-term lease from a corporate guarantor for dental, that's really valuable. And so I just think from time to time we've found a substantial arbitrage opportunity between, the seller's view of what his or her real estate was valued at, and what like the fair market value of that asset was. And we sort of looked at it a bit like a funding source for our acquisition, where the money we could make on the real estate would help us pay for the operating asset. And so it's a little bit of a complex way to think about it, but said differently, what you could theoretically do if it was, if I didn't have a company, it was just my company, you could buy that property, personally, and turn around and potentially sell it for more than the property owner made on that asset, depending on the arbitrage there.
Yeah,
it's pretty crazy.
It's a great strategy for growth. I mean, there's pros and cons to both things, right? Like, I think what you mentioned, there's a little bit of arbitrage there, which is definitely true. Like, so, the value of the building goes up a little bit when you go from a single operator to like a DSO, to an accredited investor, right? And but of course, like, there's risk involved too. And so, like, I understand why some of the doctors, even though they may be leaving a little bit of money on the table, like, they're de-risking by a lot, right? So if, like, you sell your business and you sell your real estate at the same time, especially right now, you're taking advantage of the low taxes, like the tax rates might go up, right? And you're also taking advantage of low interest rates, which is going to drive the cost of building up. And when interest rates inevitably go up, that'll drive the cost down. But we like holding real estate for that same reason of DSOs, because like it is very recession proof. It is very pandemic proof. As we found out, I heard recently that dentist has the lowest default rate out of like any business almost.
Agreed. Yeah, on the SBA, if you look at the SBA default rates, it's like the fourth out of like 450 industries.
What's 1 through 3? Do you know?
One of them was actually, you would never guess, it was
hair salon.
Breweries. Breweries.
Wow.
Yeah, breweries, one of them, and I can't remember. I have it somewhere though.
People drinking good times, people drinking bad times.
That was a long time ago. I would guess now, with all the proliferation of all these microbrews, that maybe that's not the case.
Okay.
But
yeah, so exactly. I think I think dental as an asset class is somewhat undervalued. I think it's going to go up over time as people start to kind of realize this. And also, though, you don't have to necessarily come out of pocket yourself to do these deals. Like, you can partner with people, right? Like, if you want to own dental real estate, there's plenty of investors out there, like, who are willing to co-invest, to make a deal. Like, I'm sure you'd be open to it. We're open to it. You can just pick up the phone, hop on Facebook, reach out. But there's people, if you want to buy a dental property, there are people there who you can partner with in order to get it done. So it's always not a yes or no, it's a how, right? And so I think that's some of the stuff that you guys have done as well. It sounds like just in having such rapid growth at DSO.
Yep. Well, it just depends on what you're trying to accomplish. I think if you're a single doctor, owns one practice, like, owning the real estate's a good for many reasons, especially for tax purposes and deductions and so on. But my mindset's different. Like, I'm like, if I can sell my real estate assets for 20 times EBITDA, and I can buy practices for a fraction of that, like, I'm running an operating business, right? And I'm buying operating cash flow. So it's just a little bit different of a mentality, versus being like a single doctor owner, because my view is like, my cash is like, I think the dental practices are, especially the ones we partner with, PPO, fee-for-service practices that typically are in communities for 30 plus years. My doctors retain ownership. There's great team members. There's substantial opportunities for growth. And so from my mind, like, it's a great opportunity for us to, if you want to put it in cap rate terms, to buy an asset at a very, very attractive free cash flow yield, or cap rate, or whatever you want to call it, and then optimize and improve it. And so to me, that's sort of where I'm more excited than clipping a mid to high single digit return on a property.
Yeah, no, it makes sense. And so that kind of leads us into the how you started the DSO, how you started Select Dental Management. So, being a finance guy, you said like you didn't know how the sausage was made. So, like, how much do you think it's hurt or helped not being an actual dentist, like not knowing what goes on, fundamentally or chairside? How did you overcome that?
Yeah, I mean, listen, my background is like I always tell my doctor partners, like I have no idea how to place a crown, but I know how to analyze businesses and industries. So fairly quickly, like that's what I do. Like I'm used to getting up to speed on new industries. So like I understand every tooth number. I understand, like at this point, I understand a lot. And I had a lot of numbers and understanding early on. I just didn't have the experience of how to like impact those numbers or outcomes. But listen, I think it's always helpful to have an outside perspective. And not be wed to like previous conventions that may or may not be accurate or correct. And so, while I didn't know everything, I was willing to try a lot and experiment. And I thought, a lot about ways we could improve and grow. And the first year in operation, 2018, we acquired 4 practices and we grew them organically more than 50%. So we grew from about $1 million in revenue to about $1.6 million on average. And that's without, having any experience in dental. And frankly, not doing a good job of helping my team members prioritize the most important things and not doing a good job of, explaining why we're doing things and why it's good for the patients and getting buy-in around culture and vision, which we're super focused on right now, and have been over the past several years. So in any event, I think that, I think at the end of the day, there's commonalities in every business about what leads to success and to growth. And in my mind, having that alignment, our model is a partnership model where we have doctors that are owners, that are, they win if we win and vice versa. They lose if we lose. And honestly, by focusing just on the patients and making sure we're focused on improving quality of care and experience, it's like if we do that, we're growing our practices and we're building more value, and we're doing it in a way, which is why I love dentistry, in a totally win-win-win way. It's a win for everyone involved. It's a win for the doctors, right? Because they're getting some liquidity, they're getting support. We're helping them transition and find those associates that can become owners as well, which are really, really hard to find. And for the associates, we're giving them strong guaranteed compensation. We're giving them unlimited continuing education effectively. We're giving them mentorship, putting them in great practices where there's lots of patients and great places to learn. And then on top of that, we're helping them become owners in the practice as well in a very clear period of time. So it's not like these stories you hear where and I hear them all the time, like Dr. So-and-so said I could buy in or partner with him or her, and then it's 7 years and it hasn't happened, and then they sell their practice to someone else. So we're just trying to create, again, a win-win for everyone where we're all in this for the same reasons and we have the same values, and we're all working hard to improve and grow, over time.
Yeah, well, I mean, you mentioned it earlier, you said support, right? And I think that's one of the core principles of a DSO, is a dental support organization, because the idea was a lot of dentists like doing putting on the crowns, like you mentioned earlier, right? They like doing the chair side work, but when it comes to wearing all these hats of an entrepreneur, I mean, when you open up a dental practice, you got to hire the front desk, and then you got to be the manager, and you got to be HR, and you got to be marketing, and you got to do payroll, and you got to do all these things. And there's so much more than just being a dentist and doing the work that you love. And so that's where the synergy comes in, and you marry those two things together where somebody like you or a group like you essentially takes care of that. And so that's why I think we've seen such an explosion of mergers and acquisitions in dental in the last 10 years. And you mentioned also talking about how you partner with the doctors. You give them different options. I mean, typically when you come in, how are you structuring these acquisitions? How much equity do you buy versus the doctors keep and that sort of thing?
Yeah, so I would just differentiate, and I know it seems subtle, but it's critical for us about we call ourselves a DPO, dental partnership organization, and we really stress that partnership word a lot, because it really does define on how we interact with our practices and our partners. And it's just a different way of approaching things. In some ways, it's a lot harder. There's a lot of things that are harder to do in a partnership or decentralized way. But our view is that we need to preserve the identity of the practice that got them to this successful level. Like, you mentioned our average practice generates about $2.5 million a year in revenue. That's like the top 0.1% of dental practices, right? So like, I don't want to come in and be like, oh yeah, you guys have no idea how to do all these, things. We're going to do this better. Like, we can do it better than you. Like, to me, that doesn't make any sense, right? I'm going to pay all this money for something, and then I'm going to remove the DNA that really built it. And that's like, I think, some of the mistakes we see happening in the marketplace. So our model is like, hey, we're going to partner with you. We're going to preserve what you built, and we're going to grow on it collaboratively. And if you're great at treatment plan presentation and, helping educate patients on their needs, like, we're not going to touch that. But if you are really not doing a great job on perio or on patient retention or on marketing or whatever, we're going to help work on those areas that we can focus on, and we're going to set up a framework that enables us to drive execution and doesn't rely just on the dentist to get from point A to point B, because, as you said, it's really hard to do that, while you're behind the chair. So the structure of our deals, I mean, honestly, we can be very flexible. A lot of times we come in and there's a younger doctor and there's an older doctor, and they have two different, timelines and needs. We want to have at least one equity owner in the ownership structure that's a dentist. And so our average deal is probably, call it 77-23 on average, right? Of like 23% retained equity ownership that gets cash flow distributions and, has opportunity for value creation through growth in the practice over time. So again, we're all aligned and we're all, focused on the patient, but also it makes it a much more scalable model for me, because I know that, like, when a doctor spends $1, like, it's coming out of his or her pocket as well, and so I don't need to be as far in the weeds. We really operate a little more strategically with the doctors, and we point out the opportunities, and we show them analytics, and we show them why we think something can improve, but we really also just we leave a lot of like the day-to-day decisions really at the practice level.
Yeah, and that's huge. And obviously the proof is in the pudding, because, like you said, 0.1% of the top producers in the industry is really impressive. So congrats on that.
Yeah.
And then, so, in terms of like growing from, 0 to 31 locations essentially in 3 years, right? So what do you think has been the biggest learning experience for you?
Yeah, I think that the growth has come because we've built a good reputation through our culture and values. And I think I did not understand when I first started. I thought it was like a stock, right? Where I was like, all right, this practice, it's underperforming, and I'm going to improve A, B, and C, and then it's going to be worth Y. And like, that was my mentality around buying
the quantifiable numbers, right? And the metrics.
Yeah, like, here's revenue per active patient, and here's their pre-appointment rates, and like, I could like identify the opportunities, analytically. But as you start to scale, what's way more important than your individual skill set is your ability to lead and to really help ensure everyone's aligned and rowing in the same direction. And my biggest learning experience was in 2019. I was I'm a member of a networking group called the DEO, which I'm sure you know of, and we had a leadership event, and we did a self-assessment on our organizational health of our businesses. We answered 25 different questions based on Patrick Lencioni's 5 Dysfunctions of a Team and some other books that he's written on organizational health, and then at the end of it, they were like, hey, add up what your numbers were from questions 2, 6, and 8, and here's your ranking in how you do in voicing clarity in your organization. So how you're doing in aligning people. Here's how you rank on like reinforcing that clarity and all these different components of leadership. And they were like, a score between 10 and 20, you're excellent. 5 and 10, you're okay, and 0 to 5, like, you should jump out the window, you suck, or whatever. So you're not a good leader. And like I was basically like all at the bottom. Like, wow. And I was like, wow, I was like, now I get why, because I was like, why can't we do more? Why aren't we all on the same page? And the reality was, I was like, because I'm not leading that effort. I'm a multitasker. high energy. I like to do a lot of different things, but that doesn't work for a company. Like, we need to really focus on fewer things and doing those fewer things well. And pretty soon after that, I really started jumping right into, like, I realized how much I need to learn about leadership, and just started doing a lot of reading. And we ultimately adopted Traction in Traction EOS, which is based on the book Traction.
From the book.
A couple years ago. And, like, honestly, that's when it started to all click, because that gave us the platform to really, like, get on the same page and set goals and hold ourselves accountable.
Yeah, I've heard so many good things about Traction all the time. And for everybody listening, it's a book that they go through and they spell out EOS, which is the entrepreneurial operating system. And it really just gives, like, great, fundamental, practical ways to, like, systematically improve your business, each aspect of your business. But it, equally as important, it also helps you know what not to do, right? I mean, was there anything that you guys cut out as a result?
Well, I mean, I think what you start to learn is that, like, there's more good ideas than there is time in the day, right? So the biggest thing that EOS helps you do is filter out the noise and to focus on the most important strategic initiatives in your organization and the things that are, challenges or opportunities. And so, there's constantly stuff like, we'll be like, oh yeah, we have to do this. And we're like, but it's not a priority. Is it more important than these three things? No, it's not. So it's got to sit in the parking lot. And I think, honestly, that discipline is, like, it's critical to success of an organization, is the ability to prioritize and the ability to say no. Even now, I mean, I've got, 48 people in our centralized support services function right now. We still don't have enough capacity to do everything we want to do. Wow. Right? And that's okay, right? And it's taken me a while to figure that out, because I'm
infinite game, right? Like, there's always something, you know what I mean? There'll always be something. And the second you do there's new technology that creates something else.
So it's just a matter of that prioritization and focus that I think, we still struggle with. It's you're always, you're biting off more than you can chew. Your mouth is bigger than your stomach, and you just sort of, it's all so appealing, but you got to start getting comfortable with the fact that, your execution substantially deteriorates the more you take on.
So, it sounds like that was really one of the keys to unlocking some of this growth for you guys. Where do you see Select Dental Management going from here?
Yeah, and listen, I think we're really, growth, we measure things. When John and I started the company, our most important metric was doctor retention. That was what we identified as, like, if you look at groups across the country, I would argue that there's a substantial correlation between success and doctor retention for a million obvious reasons that I don't think we need to even go through. So, my view is, like, I want to partner with like-minded people that are, that share the values that we share and that we can help. And that we can be a preferred partner for, and that's definitely not everyone. It's a subset of the population, but for those folks that fit our model and fit our values, like, I feel like we're the best partner for them. And so, my goal is just to continue to stick to our knitting, and as those opportunities present themselves, to be in a position to be the partner of choice for these high quality practices that are really focused on quality of care and patient experience, and really want to make sure that the legacy of their practices is preserved and that their patients and team members are taken care of, but also understand that it's really critically important to continue to grow, both personally, professionally, and as a practice, to remain cutting edge and state of the art, and to kind of retain that competitive advantage at the practice level.
And are you guys
are you
going through 100% acquisition right now?
Are you growing
100% through acquisition, or do you do any de novos?
We don't do de novos now. I think we talked about this. Like, I don't think I'm smart enough to do it. It's a different skill set. I like buying an existing business that has cash flow and patience, and working to grow that. I think the de novo model is a phenomenal model if you know what you're doing there. Yeah. And if you don't, it's a total nightmare. And there's not that many groups in the country that I've come across that can do acquisitions and de novo as well.
Do you think,
typically, it's one or the other.
Obviously you're very niche in the parameters that you just spelled out. Do you think you'll ever get to a point where you'll have to do de novo to continue the rate of growth, or would you, or do you just not think that's an option?
I mean, listen, there are, would I take two practices, build a new practice and combine them into that new practice? Absolutely. That's not a de novo to me. That's a merger or like a consolidation, right? So we've thought about, we actually are doing that in one market now. But just to like go to a location and like pick the corner of Maine and like plop down, it's just not our model right now. I mean, the way we grow our practices is through, we have 90% plus patient retention rates.
That's great.
Like, new patient growth is sexy and fun to talk about, but like it doesn't drive growth in a practice. I always tell my patient and my partners, I'm like, I show them a chart. I'm like, two practices, they each have 1,000 active patients. One has 500 new patients a year, the other has 200. Which one do you want to work for? And everyone says 500. And then I showed them the retention rates. I'm like, well, this practice is losing 650 patients a year, so you're actually in the hole 150. This practice only loses 5% or 50, so they're actually growing at a much faster rate. And it's the idea of like, it's all about like, it's really hard to fill a bucket with a big hole in the bottom of it. And so the nice thing about our model is that we have generational patients and we've got great reputations and presence and referrals. And yeah, it's not, again, as sexy as, oh, I have 130 new patients a month, but like, how many of those are you retaining? What's the value of those patients, right? What's the cost of servicing them, right? What's the opportunity cost? Are they showing up for their appointments? There's a lot of things. And I'm not saying I'm against new patients. I'm not. It's just, I just think for us right now, there's just a tremendous opportunity to, partner with these practices and grow them substantially. So when we look at our practices that we've owned for more than 2 years, if we look at the first 8 months of 2021 versus like, the practices we owned in 2018, we've grown them over 40% on average. And then like practices we owned for 2 years, we've grown 25%. The practices we owned less than 2 years, we've grown 10, and 1 year are growing like 3. So like, my point is that like we have figured out like a kind of hybrid model of like we can grow these stable cash flow producing assets the right way, and to me that's really attractive. And I think to be successful in de novo, there's a whole another set of skills around obviously marketing and site selection, and that I just, again, God bless if you can do it, awesome, but it's just I'm a believer in focus, and I think for us for the foreseeable future, I don't see us planting a flag. And if I always say it's like when I was on the other side of the fence investing in companies, if I saw a great business with a CEO that all of a sudden is running away from their business and doing something totally different, it would always give us pause. Like, why is he doing that? If this is so good, what are we missing? Like, and it's honestly something that more often than not led to that CEO losing their job and led to shareholders losing money as well.
Yeah, it's like the guys who start a business, plateau, can't figure out how to make it grow. The marketing works a little bit, and now they start a marketing company, right, for this particular niche. And it's like, well, if you just stick with your actual, if you like get past that hump, you have more growth. And instead, all they're doing is coaching other people how to get to the level they figured out, and then they get stuck, right? So yeah, it's like we start chasing these shiny objects. It's definitely a red flag.
I mean, sometimes you need to pivot, right? If you have a model that's failing, you need to pivot. But if you have a model that's working well, don't screw it up. that's my, it's like then don't get too, then just hone in that skill to make that model even better.
Yeah. Yeah. And so I want to talk real estate strategies a little bit too, in more detail. So I know right now you guys currently lease all your locations, right? But you're thinking about putting together a program to where you're going to start buying them?
Yeah, I mean, we've discussed the idea of, a lot of my dentists own their real estate. And to your point, not all of them want to sell immediately. But I think over time, that when they leave the practice, maybe they do. Some want to have those as income streams, and I get that. But I do think it makes sense to have the ability to purchase real estate. And I think like, while I said for my business, for Select, it doesn't necessarily fit with our investment characteristics or parameters that we look for. If we put our real estate hat on for a second, like, they're great assets, like we said, and you can create them at really attractive, unlevered returns. And so, we've thought about, again, different ways to help facilitate that, whether it's a closed-end REIT where doctors can contribute, some portion or their ownership in a single asset on a tax-free basis into a closed-end REIT that has a yield and they can diversify, et cetera. There's different ways we've thought about it. Honestly, again, back to the focus argument, there's only enough time in the day. So we've more been thinking about it more like one-off opportunistically rather than systematically.
You almost like a management company at that stage, right? Like you're going to start acquiring them.
Well, yeah, I would do it as a separate company. I would basically, again, like, and this is something where like I would just start a separate, and I have a good friend of mine that we've done does a lot of real. He's actually a substantial real estate investor, and we would, we've talked about it. Like we would hire a CEO, we'd raise outside capital, and then we'd go and try to buy a big portfolio of assets to start, and then kind of do bolt-ons and scale that way. So that's a different type of strategy, but it's something we haven't honestly really progressed with because we're both sort of underwater with what we're focusing on now.
Yeah, no, definitely. And like I said, I think it's smart. It's certainly a smart way to grow. And if you do it independently, and look, what a lot of guys do, they have their private equity or their bank funding that's explicitly directed towards acquiring new locations and the operational business side of the industry. But if you personally are able to invest in the real estate, then, like you said,
yeah,
you can leverage that for sure, especially when you're the one as a DSO coming in and providing value to, like, you're signing on the lease and you're increasing the value of that. Yeah, there's definitely ways to structure that to work for everybody. So, and then, lastly, like I always ask people, like, where do you kind of just have fun? Where do you see the economy going from here?
Yeah, no, I have been so like head down on my business that I sort of pay high level attention to, the macro, but not honestly as close as I used to. And so, for us, honestly, I think, we just, not always as you try to focus on controlling what you can control. And, I think we're just kind of focusing on, again, like how can we improve quality of care experience, patient retention, what are the things we can do to improve our practices. And, the macro is somewhat irrelevant to me. And if it gets better, then great. And if it gets worse, then we'll have to run a little bit harder. But, we're just focusing on building a really unique flywheel that can outperform the market over long periods of time. And, I said to my team, when COVID happened, I was like, this is when fortunes are made and lost, right? In times of distress. And, I think it's we're just trying to make sure we obviously, continue to execute, build a great reputation, and build that pipeline of doctors and retain them and train them. And also obviously preserve the right, liquidity and capital structure so that when these unexpected things happen, and they do, as we all know, that we are able to not only weather the storm, but take advantage of it.
Yeah, so true. And it was true, right? Like if you look back at COVID, people who were brave enough to invest in the market, every single day it was going down, right? But if you just invest in the S&P, the returns between last March and today, I think March 21st was the lowest. At the time, it was so scary, right? Like March 22nd, when it started to rebound, it was like, this is a dead cat bounce. Like it's not going to go up. But people who had, diamond fingers or diamond hands, whatever you want to call it, they saw the opportunity, they capitalized on it. And it's the same with a lot of things, right? Like, but whatever business you're in, like with dentistry, especially too, like the winners and losers were made, and that's always the case. And so, yeah, if you have strong conviction around what you're doing, you can definitely make a lot of money. So it's good because, for me personally, I can have a tendency to get too lost in the macro, right? And then that causes analysis paralysis. But really, at the end of the day, there's always opportunities in every single market all the time, and so you just got to be opportunistic.
My favorite Buffett quote is probably a couple, but is be fearful when others are greedy and greedy when others are fearful, right? If everyone is telling you about how much money they're making in the stock market, generally over time, not over the past couple of years, but over time, it's been a good indicator that things are not going to be sustainable. And when people are, worried about every single little thing and so on and so forth, i.e. COVID, et cetera, like that creates opportunities. And so, it's easier said than done because there's a reason that there's opportunities because there's real risk and it's hard to understand. But generically, I think that's been something that I sort of...
Yeah, and I think it's difficult too because how do you classify greed or fear? Like as a macro sense, right? Like because even right now, like a lot of people are greedy in the residential real estate market. Like I think it's going up and up and up and up. But there's a lot of people who are really fearful, right? Like I know a lot of people talking about like, oh, it's too high, it's got to correct soon. Like this can't be sustainable. So which one of those two do you look at as your indicator? Are we more fearful or more greedy?
Well, I mean, I think you look at prices as the indicator of like where that's the weighing mechanism. What's happening to prices, and I don't know. I mean, they've been going up pretty substantially where I live. In most places, I don't know. You know more about what the current trends are, but no, it's again, like that's why I'm like if you buy a real estate asset, then you could do one of two things. You could buy it and hope the market improves, or you could buy an asset that you can actually improve cash flow for, and then it doesn't really matter, right? Then you can actually, you're creating real value. You're not just, taking a bet on the macro, which, is hard unless you're doing that. And even if you're doing that, I mean, my old boss at one of the funds I worked for was one of the guys that got the subprime mortgage crisis right whatever, 15 years ago. And, and after that, he made a lot of macro investments. Some of them worked and some of them didn't, It's, shorting the pigs, like Portugal, Italy, and China, the yuan, and also it just takes time. Sometimes it takes time for those things to play out. So it's hard to be, it's really hard. Like there's very few, if you look at the best performing investors of all time, I can't think of one that is a macro investor. They're mostly fundamental. Yeah,
that's so true. Okay, so if people want to learn more about Select Dental Management or get in touch or anything like that, what's a good way to do so?
Yeah, so our site needs to be updated. We haven't prioritized it, but certainly check out our site, and my email's on there, and I'm on LinkedIn. So
www.selectdentalmanagement.com.
Correct.
Okay. I'll keep that in the show notes for everybody as well. So, okay. Well, that's great. Yeah, thanks for your time, and you guys are running an impressive business, and it's awesome.
Thanks, Austin.